In this video, I will share the 9 steps to wealth as shared by Warren Buffett. If you want a shortcut to grow your bank account, make sure to stay until the very end, because if you apply each one of these principles, amazing things will happen. Most people only listen to their parents or their colleagues or their friends about money. And that's why they tend to have the same net worth and the same income as the people around them. But I ask myself, what happens if I clear all that out? I start from a blank sheet of paper and I study the experts in the world, the people who have really done it. What if I put their principles in my brain? What will happen? I watched through the videos of Berkshire Hathaway, the investment company that Warren Buffett has, all the annual letters, and I took about a year to go through all this material, and I read several books about him, and I came out with 9 points, the most important 9 points that we all can apply in our life. I highly recommend you going through this yourself. It's only a few hundred hours of videos, a few thousand pages to go through. If you do not wish to do so, here are the 9 steps to wealth as shared by Warren Buffett. Invest in productive assets and avoid the rest. Warren has been asked countless questions regarding gold, silver, and Bitcoin. It is easy for an untrained eye to look at different asset classes and see them as of equal value. But Warren makes his statement very clear. Invest in productive assets and leave the rest. He makes one example: if you would gather all the gold in the world into a giant cube, then you could touch it all day long, you could look at it, you could admire it, but it would never produce anything. It would always be the same amount of gold. In 100 years, it would still be the same amount of gold. Warren's friend Charlie Munger, he adds that during this time you owned all the gold, you would have needed an army to protect it. Warren, he says that if you would look at the Earth from space, you would see people digging up gold from one hole in the ground, taking it and putting it in another hole in the ground where it would be stored. And this would look like a rather strange and peculiar activity. Regarding Bitcoin, Warren makes the comparison to tulips, which prices rose to insane level in the Netherlands in the 17th century. Neither gold or Bitcoin will ever produce anything. So what Warren says here is that you need to rely on what he calls the greater fool theory. You need to hope that someone else will pay more for the asset in the future. This might go well for a period of time, but as soon as someone stops to ask what the actual real value of this asset class is, then the whole charade stops. What Warren wants to buy is parts of other companies. And why, you might wonder? Because if you would buy a third of the company Coca-Cola, for example, each year you would be paid a third of the company's dividends. So when the company is making money and it's making profits, it pays out a part of those profits to the owners. And you, owning a third of the company, would be paid a third of those dividends. The company is producing profits, and you, as an owner, take part of those. Businesses have a compounding nature. That means that they grow. Warren also makes the example here: if you would buy a farm, you could calculate how much this farm would produce, how much the cost of the farm would be, how much the cost it would be to run it, how much you could sell the corn for that you produce. So in this case, it's possible to calculate the value of the farm, because you can see how much it will produce each year and how much profit you can make from this investment. As a matter of fact, Warren did buy a farm in his 20s, and he made a deal with a farmer who'd run it for him, and then they would split the profits at the end of the year. You see, Warren is all about what an asset can produce and how much he's paying for it. If the market crashes or an asset class goes down in value, investors like Warren is there to see if they can find an opportunity to buy at low prices. You see, the most simple way we can value a business is by looking at what we call the PE value, price to earnings ratio. So this is the price per earnings ratio. How much are we willing to pay for how much the company makes? So for example, if the stock price is $10 and the company is earning $10 per share, the PE would be 1. If the stock price would be $20, the PE would instead be 2. Invest in the US stock market in a low-cost index fund. Warren is mostly investing in the US market, and he is often asked why he's not investing in, for example, India or other developing countries. And his answer is that he does not have any knowledge that makes him a better investor there. He does not have any advantage to invest in these countries. He knows the US market and he is very bullish on the future of the US. Here are my thoughts why. If we compare companies in the United States with companies in Europe, The ones in the United States will have an advantage just by how tax laws are structured. You see, a company in the US who's selling consumer goods is not eligible to pay VAT, the sales tax. This means that more money stays in the company and can be used for marketing, hiring excellent employees, or product development. It is like swimming with the tide here. A company in Europe is eligible to pay VAT, a sales tax, which means that for each sale, 20 to 25% of the revenue will go directly to the government. If a company has a 10% profit margin and they pay 20% VAT of revenue, that means that the government is actually making twice as much money as the company itself is doing. And this is swimming against the tide. So let's compare two identical companies. One started in the US and one in Europe. The one started in the US will be profitable and grow much faster than the one started in Europe. This is an example of how tax laws can help or hinder the growth of businesses and the whole economy. Warren has many times advised people to invest in a low-cost index fund tracking the S&P 500, which means the 500 largest companies of the US stock market. He puts an emphasis on the lower the cost, the better, simply because many people are paying way too high fees to fund managers. In one of the shareholder meetings, Warren pays tribute to Jack Bogle, the man who invented the index fund. Warren Buffett says that Jack Bogle has done more for American investors as a whole than any other investor Warren knows. During the last 100 years, the S&P 500 has returned 10.65%, assuming the dividends are reinvested. This means that the capital invested would have doubled every 7 years. One of Warren Buffett's disciples, Mohnish Pabrai, he puts an emphasis on how many doubles you can get in your lifetime. He says that you can either start investing while you're very young, or you need to become very old. But if you can invest during a period of 50 years, you should be able to get around 7 doubles into this period. Let's say you've managed to gather $100,000. This doubled 7 times would be $12.8 million. And this assuming that you never put another dime into your investment. This is the power of compounding, which Einstein called the 8th wonder of the world. It is so powerful, most people simply cannot grasp it. Charlie Munger, he used to joke about that when Warren dies, he wants to be known as the oldest corpse someone ever saw. And this is simply because Warren wants the compounding to go on for as long as possible, and he wants to get as many doubles as he can into his equation. Stock picking is for the pros. During one of the annual meetings, Warren he pulls out a list of the auto companies started in the US in the early 1900s. And this industry was booming at the time, and it was easy to think that this is the industry of the future. One might have thought that if you simply would have bought shares in a few of these companies, you would have been set for life. You would have done well for a lifetime. And Warren he found a list of more than 2,000 auto companies started over the next few decades. But in 2009, when Warren made this example in the annual meeting, only 3 of these companies had survived. And this is an example of how hard it is to pick stocks. And the average person tends to overestimate their own capacity to outsmart the market. And this is exactly why most people actually lose money in investing. They would be doing so much better simply by investing in a low-cost index fund tracking the S&P 500 month after month. When the market is going down, they will get more shares for that amount that they have set aside for investing. And when the market is going up, they will see the shares that they own increase in value. And statistically, over a lifetime, this will have grown to a large amount. The best investment you can make is in yourself. Where will most of the money in your life come from? And what is the vehicle that will feed both you and your investment accounts? Well, the answer is you. The first $100,000 that goes into your investment account will be needed to be generated by you. After that, it will be much easier because your money will actually start to generate more money. But it is of crucial value that you learn how to generate and put aside money. Warren says that most people fail to reach their full potential. And he also says that the best investment one can make is in oneself. This can be done by investing in high quality courses, education, but it can also be by reading books, business magazines, and engaging in continuous learning throughout your life and career. And some things that you can do for free are, for example, watching the Berkshire Hathaway meetings, reading the annual reports, and also breaking bad habits and developing good ones. As Jim Rohn used to say, don't wish it was easier, wish you were better. After my first real business failure, I took these words to heart, and I understood that I need to become a pro rather than just being a beginner. I needed to become an expert in what I was doing and become a person of value that other people wanted to listen to and get advice from. So I took several expensive management courses and seminars, and the knowledge I learned there I actually use each week still today. Warren Buffett, he refers to when he took a course on public speaking when he was young. Up until then, he was too shy to talk in front of others. He would much rather sit in the library of the city and reading books about business and investing. But he understood that in order to do what he wanted to do, he needed to develop the ability to communicate with others and to share all this knowledge that he had. And the first time he signed up for this course on public speaking, he was actually so nervous he didn't show up. But then the second time, he actually managed to participate and complete the course. Later, he began teaching at the university in order to continue to develop this skill. And he has then continued to teach throughout his entire life during the Berkshire Hathaway annual meetings. And Charlie Munger, he actually adds in one meeting that the reason that Berkshire Hathaway has been so successful is because he and Warren has never stopped learning. They have always continued to learn and develop themselves. And I can share that my own best investments have been in my own skills, in myself, and in that way I've been able to generate money that I then could put aside for investments. Become valuable, become an expert, become someone that other people want to ask for advice or other people want to hire. Use the law of reciprocity. Investor Mohnish Pabrai, he talks about how Warren Buffett uses the law of reciprocity. And I'm so glad I watched these videos with Mohnish Pabrai because I had not seen this myself. And Mohnish Pabrai, he explains it as when we were hunter-gatherers and we had taken down a mammoth or something to eat, there was no place we could store all this meat. So we only had, for example, 24 hours to consume this animal. So where did we use to store the meat? Well, the answer is in the bellies of our neighbors. We invited everyone for a feast, and we knew that they would do the same thing when they had seen success in their hunting. This principle is so deeply rooted in us as human beings, and it still works today. And Mohnish Pabrai, he tells a story of members of Hare Krishna, how they use this principle. They would approach a business person in the airport, offering them a free flower. And they would insist that this person accepts the gift of a free flower. Then later on, they had another person asking for donations. And they found out that the person who had accepted the flower were much more likely to donate, and they also donated more. So now let's look at how Warren Buffett is actually using this principle. So Mohnish Pabrai, he runs a charity in India called the Dakshana Foundation. And they basically scan India for extremely intelligent children who are poor. Then they help to educate these kids and help them to enter the finest schools in India. So one day Mohnish, he receives a letter from Warren Buffett saying how impressed Warren is by his foundation, and it's signed by Warren Buffett himself. And this is so genius because now when Mohnish have received this letter signed by Warren Buffett, of course he will frame it, put it in his office and tell all of his friends how amazing Warren Buffett is. So by a very small act of kindness that took very little time from Warren Buffett, he has created goodwill that might come back to him in the future. Warren probably takes time each week to write several of these letters to different people. And even though he knows how valuable his time is, he still sets aside time for this activity each week. And this must mean that he finds this a very valuable activity. Let's assume he writes 2 letters per week. This will result in 104 letters per year. So he has now created 104 small acts of kindness that might come back to him again in the future. And the people receiving these letters might share to everyone what a great guy Warren is. And maybe one of these people have a business that they want to sell. And what does Warren want to buy? He wants to buy great businesses. And he can never know for sure what will come out of these acts of kindness, but he knows that good things will come out of them in the future. And in my own life, this has actually been one of the most high value activities I have taken part of. Sell by teaching. I recently saw a video with Grant Cardone calling Warren Buffett the world's greatest salesman. Interesting, I thought. I don't think of Warren Buffett as a salesperson. And probably that's why it's so genius, because I had the thought that Warren is this kind grandfather who's teaching everyone about investing. And while this is the picture that most people have of him, he's actually skillfully selling the idea of investing in Berkshire Hathaway. So Warren here, he's selling by teaching. He is extremely generous and he shares all of his knowledge for free. And by doing so, he has created one of the largest, most respected and trusted companies in the world, Berkshire Hathaway. So how can you start applying this in your life? What expertise do you have that you can start sharing with others for free? Emulate those you admire. Warren advises those in school to look at the people you admire and write down a list of the quality that they possess. It can be generosity, giving credit to others, humor, etc. And then look at the people that you don't like and then write down a list of all the qualities that they possess. It can be qualities like taking more than they give, having a bad character, participating in bullying, for example. And now when you have your two lists, make sure that you start to emulate and learn the habits and the qualities of those people you admire, and make sure that you don't have anyone from the bad list. And if you do, make sure to work on breaking those bad habits. You see, both Warren and Charlie, they talk about the importance of having the right heroes in life. One of Warren's earliest heroes and mentors was Benjamin Graham, who wrote the book The Intelligent Investor. And Warren actually went to study for him at Columbia University, and then he went to work for Benjamin Graham's investment company. And Charlie Munger's greatest hero was Benjamin Franklin, and this influenced Charlie a lot to be a multidisciplinary person. He had a law degree, he was skilled in psychology, he designed houses, and he participated in philanthropy. So simply by choosing the right heroes in life, it will influence how we dress, how we walk, how we talk, how we do business, how we don't do business. It will give us the courage to do the things that we really want to do. So take a pen and paper, write down who are your biggest influences in life, and make sure that those are people that you really want to emulate, that you want to learn qualities from. Because simply by doing so, you will start to gravitate towards a new direction. Focus on earning ability, operating earnings. Warren Buffett is notoriously talking about operating earnings in the annual meetings. And in simpler words, this means the actual profit that the many companies that Berkshire Hathaway owns, how much profit they produce. Only secondarily does he talk about the share value or the value of the actual companies. His primary focus is the operating earnings. He says many business leaders talk about EBITDA, which to him is a distorted number of profit. His friend Charlie Munger calls it bullshit earnings. Business educator Brian Tracy, he talks about the skill earning ability and how one can develop this skill in oneself. To me, this is very closely related to what Warren is talking about. A company should focus on operating earnings, and an individual should be focusing on earning ability. In other words, how much money the actual business or the individual can produce. How much net income can you take home? How much do you put aside for investments? If you or your business can make more, then you will have more money to put aside for your investments. If you own a company, the actual value of the company will be higher if you can increase the operating earnings. I once met a man who was wealthy, but at the same time he was broke. And you might wonder, how can he be wealthy and broke at the same time? But let me share the story. So we were sitting around a dinner table eating dinner, and this man was wearing nice clothes. He talked like an upper class man and behaved like an upper class man. But I knew also that he owned a large mansion, a large estate, but he had very little income. So he was actually looking to sell all furniture of the estate just to be able to keep the doors open, just to be able to keep the house. I don't know what happened to this man in the end, but I do know that probably he had put too much focus on having a large amount, a large net worth, rather than focusing on the actual operating earnings or the net profit or how much money that his estate could actually produce to keep his doors open. So in this case, you can actually have a lot of money or be wealthy but be poor at the same time if the assets you own produce little or no income. A large mansion in this case can be pretty to look at, but it will cost a lot to maintain. Therefore, it is very important to know the difference between large assets and large operating earnings. Learn the language of accounting. Warren advises that as a business person, one needs to start to understand the language of business, accounting. Warren tells stories about CEOs who look absolutely terrified when they get a financial statement in front of them, just because they simply don't know how to read it. And I can share that as soon as I started to learn the language of accounting, and I could start to read financial statements and understand my own financial statement of my company, a whole new world opened up. I could start to understand how different numbers correlated with each other. I could start to think in different tax strategies, how to defer taxes, and I could actually understand what my accountant and tax advisor was talking about, because now it was not just lots of difficult words that I did not understand. I could actually think in the same language, in the same level, and we could communicate more efficiently, and I could take much better decisions regarding my own company. I could also start to understand how other companies function by reading their financial statements and seeing how different numbers correlate with each other, and get a more clear view into how a company functions. So if you own a small business or a large one, I highly advise you to become more skilled in the language of accounting, because it will open up a whole new world for you, and you will be able to make much more informed decisions. And if you are looking into investing in other companies, then you will be able to see how the company is actually doing by just reading the financial statement, and you will get a clear picture in your mind of how the company is doing. You can look at the history of the company. You will be able to understand how the business is doing. And now the last one: postpone buying a house until you're already wealthy. Until then, live in a small apartment. Warren Buffett and his wife Susie, they actually lived in an apartment and postponed buying a house until much later on. So he told her, we will buy a house, but we will actually wait a little bit, because then he could use that money. He did not need to take a whole bunch of money out of his net worth and chunk it into buying a house and it being fixed there. He could see that it was much more efficient if he could keep that money working for him and buy a house much later on. And this might puzzle some people, because if you belong to my generation, we have seen our parents and the house owners there have seen their net worth grow due to their buying the biggest possible house they could afford. But that, I think that rule does no longer function in our society today. Having a large house is now associated with very high costs, and I think that your money will be much better working elsewhere. And I've talked with many entrepreneur friends, and they have the same view as I regarding this. So the rule that trying to buy a house in order to become wealthy, that does not longer apply. So you need to get that out of your head. So Warren and his wife Susie, they lived in this small apartment, and Susie had no idea that they were actually rich until she found some checks of dividend payments that came in to Warren. And at one time she actually lost some envelopes in the trash. She accidentally threw away some envelopes that contained a lot of dividend payments, and she had to go through with a friend in the basement all the trash for the whole apartment house just to find these checks. But up until that point she did not know that how well they were doing, because they lived a very simple lifestyle. Another investor, Sir John Templeton, he also used this method in order to have more of his money free for investments. He and his wife, they lived in a tiny apartment in an attic, and they had furniture that friends had given them or that they found in the thrift store, and lived a very simple lifestyle. And he explained it as he wanted to be ready when an opportunity opened up. When he saw an investment, he wanted to have his money free so that he could just pounce on that investment and put all money into that investment. And throughout my 20s, I used this principle a lot. I actually rented rooms for a much longer time than my friends. And then I could use the surplus to invest in my own skills instead and to develop my business. And when the business started to do well, I could also set aside money for investments. And it was only until after that I moved into my dream apartment. So I postponed having a really nice place in order to invest in myself and put aside money for investments. So if you're starting out in business, having low monthly costs will take a lot of stress off your shoulders and give you a longer time frame to get the company profitable. So if you don't have enough money today to invest in yourself or to set aside for investments, maybe it would be a good thing to move out of your house, to rent out your house and living in a smaller place during that time, so you can free up cash to invest in your own skills, to become better, or to set aside for your investment accounts. And it's amazing what peace of mind low expenses actually brings to you, so you can take that money and put that into investments instead. So I hope that you enjoyed watching these nine tips from Warren Buffett, the 9 steps to wealth shared by Warren Buffett. And I hope that you can start applying them in your own life. Please leave a comment below when you start to apply these ones, or if you have any questions, how you can do it or how you can apply them. Making this research and going through all the Berkshire Hathaway meetings and reading so much about Warren Buffett and studying him has been such an amazing process, and has really opened up new ways of thinking for me and given me a new perspective of how to look at money and finance. All of us, we spend so much time of the day working, and money is such a big part of life. So just clearing out all old ideas and just learning from someone who's super skilled around this subject and has studied his entire life, almost 100 years. So I hope you enjoyed this video, and if you have any questions of how to apply these ones, just write below, and it would be amazing to hear how you put them to work in your own life. So thank you so much for watching, and I hope to see you soon again.